The markets, big tech, bond yields, we got to talk about each of those in this video. I am Dr. Stock, Doctor of Education, and if you're looking to get a new roof, I hear it costs nothing because it's on the house. All right, we have to take a technical analysis view of the markets to see what could possibly be coming up for us. I'm going to talk about the different big tech companies that we have and their impact that's on those markets. Meta has their earnings that have just come out, and so we should also take a look at those and see what they're doing, giving us further commentary, and I will also tell you how I played those. And then also Amazon stock. We have the earnings for Amazon tomorrow. We got to talk about that as well, because likely what I did for today in the markets for Meta is going to be the same thing that I do for Amazon tomorrow. So we'll see what exactly the market brings and if I do play it that way, and I will share that with you back on this channel and let you know the results of it. So I will tell you how to see my buys and sells through the Patreon. I will also tell you how to get my options course, and then I also will tell you about the free stocks available through Moomoo. In the meantime, take a quick look at this heat map that we have from TradingView and just let your eyes focus on how much red there is versus how much green there is when you look at this. And if I click on technology services, after all these pop-ups go away, Microsoft, green, a few other blips of green, maybe some logos that have green in them, but oh my goodness, the rest of it is just red. So this would be something like the NASDAQ when they talk about the tech-heavy NASDAQ and then Magnificent 7 and the NASDAQ 100. Like, you start to see why all of it does move the way that it does and why today's movement was so dramatic. And now, mind you, not all of that is due to big tech. I did mention that we also had bond yields playing a part in this. So I want to take a look at all the charts for that. So let me bring down that screen and put up this one right here that we're looking at, which is QQQ, which tracks the NASDAQ 100. And Google's getting a lot of blame for this one. Well, and they're saying mixed results from Google and what we had from Microsoft. Microsoft did very well off their earnings. Google was like kind of lackluster. I will tell you, I listened to both earnings calls, and Google's was an entirely different earnings call than listening to Microsoft's. Microsoft, it was like win, 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 strength, 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 strength. And that's why it pumped the way that it did. When you heard from Google, you heard about like headwinds and uncertainty, and that kind of is what ended up dragging that stock down. Even though the results themselves were good, I still think that Google is going to lead way to some amazing buying opportunities. And it's possible that we get a nice bounce. So as we look at QQQ, check it out. We are at the bottom right now of this trend line that we have across these previous lows. Breaking down below this gets sort of ugly. So we closed today at 350, but breaking down below that, we got room down to 346. And if we zoom out some more to see where else we can go, we can even toss some Fibonacci's up here to look at that. We have 342 down below that, and it is possible if we really get routed in this sucker. Where do we have that? That 200 day, by the way, is at 337, almost 338. Right now, so that I move up, we do want to stay on a lookout for a death cross. If this should come down and start testing the 200, we want to start looking to see if it starts breaking through it. So typically how that would work is that you would get a break, a retest of 200, and then the real sell-off. Let's go back to 2022. Look at this. That's exactly what I was just describing. That going here, where are we at? We're at January in 2022. We broke down through the 200-day. We retested, and then the real route started from there, and the rest was history throughout 2022. It's possible, just maybe, that we see that again. Now, if you look here, we didn't break that 200-day. We came down, we tested it, we popped up, we tested it again, but that was that nice bounce that sent us off. So then we were off to the races on the other side of that. That 200-day is going to be absolutely critical. Absolutely crucial that you continue to watch that over time. Let's look intraday on this thing to see what's going on there. So this is down to the minute chart. And the reason I show you that is this minute that you see right here with this large green candle and this volume pop that you get, which is pretty good for the after hours. When we look at QQQ, that's Meta right there, dropping their earnings. As a matter of fact, Qs were attached to Meta in their earnings at least up until we got to 431 in the after hours. And then after that, I think it started to become detached. We'll take a look at Meta and see if it did start following suit. But last I looked, Meta was looking really sharp on that. Let's get to SPY for right now. And then we're also surprisingly going to look at the Dow Jones, which is normally pretty boring, but I think it's worth watching. Mind you, there's that same candle that we see at 417, which is where you see that same candle, that same volume spike too for Meta. Like I said, we'll cover that in this video. So for the S&P, let's go out to the daily chart and see how we're doing. And let me zoom out on this one. All right, so now this is what gets interesting, what we have right here. So we didn't make it to the bottom of this bearish channel that we're on, but we did break down through the 200-day. That is a very bearish sign. Now, it is possible that we recover from that. Maybe we sell off a little bit more. Maybe we come down and we test 413. Should we get further softness in this, we're going to have to hear from other companies and their earnings. It's going to be a holistic view at those things. We knew that big tech was a lot of what things we're riding on, and Google having those lackluster reports was one of the big things. If it was excellent reports like Microsoft had, I think that we would have had a much different day today. But we know that there's high concentration on tech, and should tech falter at all like it did, there's where our sell-off came in. I didn't expect it to be what we saw today, but at bond yields, we'll get to that as well. That really started to drag that down. So we closed today. That close was at 417.55, down below 418, which is where I thought that we would have caught some support before, but we ended up being below that, below the 200-day. It is possible that we do break down a little bit further, come back and retest the 200. And at that point in time, if we fail to break the 200, buckle up, because I will start putting out my short positions on that one. I did take out a short hedge just in case we didn't get that same rally. My short hedge from yesterday worked. I took out another short hedge longer term going out to January 2024, and I might possibly build that out depending on what it is we see. Looking at the Qs, it's possible that we get a bounce, especially if a route like today, and it will actually just the last several days. Yes, we got a little bit of a reprieve. Maybe we sell off a little bit more. Maybe we bounce a little bit more. And Meta is also going to be very important with that. Amazon is going to be huge for that. So we will be watching those earnings, which are in the after hours tomorrow. So SPY, not too great. As it's looking right now, we want to watch for where we end up around that 200-day. If we end up bouncing, retesting, and then falling, or if we bounce, retest, and then break through resistance and go back up above the 200-day, because that could also be very bullish for us moving forward. I can tell you that the sentiment, the overall investor sentiment, and what we have for the consumer sentiment, none of those things are great. But take a look at the Dow. This one, I wanted to put this one up. This is DIA, which tracks the Dow Jones Industrial Average. So for this one, bouncing off of support. As a matter of fact, we'll put a horizontal line out here that we have a double bottom for the Dow. So not necessarily that things were great, but man, we got a bounce out of it though. We didn't return to the same lows that we had coming out of SPY. We didn't come out to the low that we had in QQQ. This was the best performer. So even though down for the day, it was down at 0.33% compared to the over 2% that we were down in the NASDAQ. And then we were down well over 1%, I believe it was. Let's go back and see exactly what it was. Since I don't have it on any of my screens right now, I'll bring this back up. We were down in SPY, we were down by about 1.5%, which is about where I thought we were. So the Dow Jones right now, if you're concentrated in the Dow, today was actually a pretty safe day for it. And this is actually where we have a bit of a trend line. There we go, correlation with this one. There we are. So there's the trend line that we were working off those lows. You'll notice that it did not catch the October lows that we had previously on that trend line, that they were even well below that. If we zoom out more, there's not much to go along with that. This trend line might actually connect even further back. There we go. It actually connects all the way back to, it looks like October, almost the end of October in 2020, before we had that rally that led up to the end of 2021, we'll say, for the Dow, and then sold off in the rest of 2022. So with that said, let's move on from there onto the next chart. And the next chart that I'm going to put up is the US 10-year Treasury yield. And you can see, like, there's some ugly stuff about it. There's a reason why the market reacted the way that it did. And I think that Google is getting an unfair amount of the blame for what exactly happened there yet. So yes, it wasn't great to see them falter. Yes, it gave us mixed results for tech, but they weren't horrible results for tech. Their guidance wasn't horrible for tech. Like, a lot of it was absolutely expected. So let's take a look at that 10-year yield for the US Treasuries. And so I'll pop that up there for you. So US10Y. There we go. And we want to go to the hour chart for this one, because I put this up in my video yesterday, and I said that it's possible when I made the original video. What I said was that we had an inverse head and shoulders, and we had this point of confluence between the neckline, this trend line coming down here, and this horizontal for historic resistance / support, that coming off of that with those high wicks that we saw, we're probably going to drop, and we did. Well, what happened? We ended up finding support down at about 4.8% on the 10-year. That was a double bottom, had these low wicks right here, which showed upward pressure, and man, oh man, this thing just ripped on us. So let me see, right here's the 25th. As we're looking at it at midnight, and then we just start moving up from there. And if you track the futures for any of the indices, you'll see that that was crushing to us. And where are we at right now? I think there's another horizontal that I need to put on here for you. So let me grab that horizontal line. It's right there. And here's where we should start to expect more downward pressure in the markets. It's right exactly here. I want to make sure that I get that right. That is the 5% mark. So this, even though they look like huge movements, they're not, but we don't want to toy with 5%. We don't want to toy with the whole 4.8 acting as firm support for us. We bounce up and start ripping back upward like we did. that's not great for us moving forward from here. Now, flight to safety. Listen to this. Actually, I have it up on Moomoo for my heat map. Let me pull up my mobile app here, and I'll tell you about the sectors that actually did well today from the heat map. So listen to this. Software did all right, 0.83% up. Oil and gas, 0.27 green. Healthcare, utilities. Let me see. Oil, gas, and E&P. There we go. Out of that, electricity and propane, I think. Beverage, insurance, aerospace, the rest of it. So look at this screen, and really all I want you to see is just exactly how much red there is there. And there's not much that's green, but the healthcare, utilities, oil and gas, a lot of that stuff is moving to safety. Flight to safety is moving out of technology and a lot of the other areas within the market, and it's moving over to those safety plays. Where is it not moving right now? It is not moving into U.S. Treasuries, which could possibly signal this could be some more of that fear in the markets. If that flight to safety is not yet Treasuries, then it could be that they see that the yields haven't settled yet, that they could possibly settle higher, which could put even more stress on the U.S. to be able to service their debt, which would put the risk of default in there. And it could just be this precipitous thing that ends up causing a whole lot more fear than we're seeing right now that pushes us down even lower. So it's something to watch. And it's not something to fearmonger, it's something to prepare for, that if you think that a market direction is coming, then you can plan accordingly. You can do it with calls, puts, long positions, short positions. There's any different number of ways that you can play it. Maybe you move in those defensive areas yourselves. Treasuries, like I said, the fact that we're getting higher yields with a flight to safety is weird, because that means, like I said, that people are not buying into those long-term treasuries yet. They could be moving to those shorter-term treasuries instead, and that could be something over time that brings down the shorter-term yields and then uninverts the yield curve. And then that could show that possibly for the short term that we're in a bit of trouble before we start to recover again. So it's something I'm very watchful for, something I want to keep on paying attention to and keep on playing those markets. So my short hedges that I put out, first one did really well for me. Second short hedge already doing well. However, it's a longer position. I might actually build it out depending on what we see from the market, for the amount of strength that we have in it or the amount of weakness that's coming to it. And I do have some long positions still out there in terms of options that I'm kind of making up my mind on about, should I hold on to those or is it time to cut them loose? Some of the ones on TQQQ, I have some time left that should we catch that near-term bounce, I think that it's going to give back to me a little bit. And it's possible that we do, especially in light of what we see from Meta and the fact that we keep on shying away from that 5%, that should we retest 5% in the 10-year yield and get rejected off of that can be a very good thing. By the way, I want to give a quick shout out to all my students that I got to meet today. It seemed like an incredible group, and I'm very excited to teach them, and I know that they'll appreciate the shout out. So I hope that any of them are watching this, and I think that they'll enjoy it. So let me move on from there, because I do want to get over to Meta, and I want to get over to Amazon as well with their earnings coming up. And I want to talk about that 417 hour that we got. So my buys and sells, by the way, because I will tell you how I played Meta Earnings, and I think it's going to really work out well for me. And then also I'll tell you about how I intend to play Amazon. It's going to be very similar, most likely, unless I decide differently when the market opens tomorrow. We're going to have to see how that story plays out before I take that options position on Amazon, but I perfectly intend to. I post my buys and sells at the Patreon. That link is down in the description. And then if you want to learn how to use options to amplify your portfolio, you can do so by looking at my options course that I'm building out right now. Moving into the application side of things there, it does start with the complete beginner, and then we'll move up through advanced option strategies, which I used one today that I'll talk about, that, like I said, I think is going to be a very good risk mitigator for not putting up nearly as much capital as I may have needed to in such an uncertain time, but still allowing me a really excellent chance for profit. And then I use Moomoo for that trading, for my options plays, and I love their options analyzer tool that they have, their options calculator, and then also just the user interface is really smooth. The earnings calendar, there's so much value there, and on top of it, they're going to give you 16 free stocks by using my link that's down in the description. And down here, they show you the stocks valued up to $2,000 a piece, and then the deposit tiers and the free stocks, including a free share of SoFi that goes along with it. Their earnings, by the way, are Monday, October 30th for SoFi. And I will be providing further coverage on that, telling you how I plan to play that one. And actually I'll even give you a bonus in this video. I'll tell you how I played SoFi today, because it's one that it was a relatively small risk with a relatively large upside potential, depending on what we see in the market. So I'll talk about that soon. In the meantime, let's get over to Meta. So on Meta, what I did for this one was I actually did an Iron Condor play on this one. So that's actually something that is meant to bound or contain the price range or restrain the price range, if you will, that right now are constrained. There's the word I want, constrain the price range from $275 up to $325. That $50 range in the stock price by Friday. I want this thing to expire. The expiration date is on Friday. In that range by Friday, as long as we close anywhere between $275 and $325, I make a guaranteed $223. Now that might not sound like a lot, and the risk is actually a little bit higher than that. My max loss on this is $290, which should we finish outside those values. Now, mind you, the break evens are just below $273 and just above $327. Those are where the break evens happen. Outside those values, I lose that money quickly. So I don't want to see it move outside those values. So I gave myself a $50 window, 25 to either direction from the close at $300. And so that would be the iron condor that I use to do that. It's sort of like using a strangle, but then also managing your downside risk. So that does cut into your profit potential a little bit. However, it keeps you from getting into a play that costs you potentially thousands of dollars with any sort of undefined risk possible on top of it. And then instead it turns it into something that, even though it does cap your profits and cut into your profits, it still significantly mitigates your risk. So I could have actually taken a move today, did a straddle or a strangle, and had it cost me $2,000 to $3,000. This one gave me $223, and I could have bought more of them if I wanted to. I felt for something that I was relatively uncertain about that was enough risk capital, of that $290 being that risk capital, whereas the $223 was the premium that I was paid to do it. So that's the details of what I did for that iron condor. And so I'll give you the details that made up details that made up the iron condor itself. So here's Meta as we're looking at it. And let's go out to the daily chart first. I'll work into the smaller time frames to talk about the earnings that they had. So let's zoom in here just to see that it went through the same route that the other stocks did. And where did we have that 50-day? That 50-day was at 303, and we closed the day at 299.53, being right near 300, and we had a decent amount of volume going into that too. So probably a lot of outflows. As we looked at it, the RSI put us down below 50. So this would actually be a day that would signal to us. Now, earnings are different. If there wasn't for earnings as a catalyst, if there was no specific catalyst, I would totally short from here. However, with earnings as the catalyst, that can be a mixed bag and really toss you into an area of uncertainty. And between what happened with Google and what happened with Microsoft, I was like, even though I'm bullish on tech, this is one that I was like, I don't want to get caught up in the same thing. Go long on Meta and get roasted like what we saw with Google, which, mind you, I played TQQQ, not Google and not Microsoft directly. So I can tell you that the long position for that I had to short hedge against, that really did cut into what it did was it mitigated my downside that I would have had to experience or realize. Regardless, I do still have those long calls out there though. So let's get down into the hourly here, and then we'll break down from there. Take a look at that. Where's Stockmo at? Stockmo would say, look at that pickle. That's what he would say. So this is at that 4 hour to 5 hour mark. And if we shrink that down, let's go down to the minute chart so we can see the minute that it happens. Take a look at this. There it is. And that's at 417, like I said. And we also saw the indices reflect it immediately. And if you remember from the Qs, we started to lower and then trail off after a while as that looked. But for Meta, we actually have consolidated significantly. And by the way, it's very, very important that we take a look at what we have from volumes, because a lot of this is rear looking as we talk about it. But between the fact that the market just got roasted yesterday, and it is possible that we end up bouncing off of the support line in the Qs that we have. Google super low, Amazon went super low, Meta went super low, but Meta came out with these results and it ended up popping things up. And right there, we just got a little bit of a volume spike relative to what we see here. So that's something that's narrowing beautifully, and that can tend to be a continuation pattern. So it's possible, forward looking now, that Meta has a great day tomorrow, and hopefully not too great for where I'm positioned. For me, I would like this to please stay under 325. It can stop at 325, and I still keep all $223 that I got from that play that I made. So if it goes above that, I quickly lose money by the time I get down to that break even. It only takes a few dollars to get me there. Like I said, I think it was just above 327 to the upside of that. You have to remember that we have GDP coming up. We also have initial jobless claims. And then on Friday, we have the personal income and outlays coming out. So those are a lot of catalysts. They can mess with the markets big time. So there's no guarantees here. Let's take a look at the hourly chart real quick, and we'll see just how high this thing would have to go and how low it would have to go in order for me to lose money on this play. So let's transition back over here, and we're going to go out to the daily chart. I said hourly, but I think the daily is going to be a little bit cleaner for us. There we go. So as we look at this, 325 is all the way up here. So almost near the previous high that we had. Now, percentage-wise, from the close, that's 8% up. And that would be moving over some pretty wild days that we had. And so around earnings time, it's not unheard of for that to happen. So there's still some risk involved. I don't want to lose that money. I'm pretty sure that I should get every one of those $223 as mine to keep by the time expiration comes around on Friday. But that's how high it would have to go, is all the way up. Let's put a horizontal line up there so it stays in place. $325. And I do still make money up till 327 something. I don't remember exactly what it was. And maybe it's 327.23. And then from the downside of that, 275, that is way down here. There's 275, and there's actually room a little bit. So the reason that I spaced this as far apart as I did was because it puts us all the way close to the previous high and down towards where we found support before. So hopefully that's what bounds us from above and below on this one, and allows me to fully capitalize on the options play that I made, the Iron Condor here. Amazon, I think, could be a very similar thing. So let's put up Amazon real quick. So for Amazon, we're taking a look at the daily chart right now, and we're getting close to that 200-day, which comes in at about $117 per share. So we want to keep an eye on that. That was quite a sell-off that we saw today. So if we actually check the price range on that one to see just how far it is off the top, and one of the concerns is Amazon Web Services demand and how much they were able to grow that over time, that it's possible that we still see shrinking growth there. So based on what we saw for the Google earnings. So this is one that moved a lot more in sympathy with it. Plus, do we have a weakened consumer outlook going into Q4 or even beyond into 2024? We're going to have to watch for that one. But I think this is an excellent candidate for that Iron Condor as well as we watch that. So we got room about $4 down from today's close. And then when we go up to the bottom of these candles here, 124, we got about $3 up. So we could actually play this a lot tighter. I put $50 apart in that Iron Condor for max profit on Meta. I don't think I have to go that wide for Amazon. And this is one I think is going to work out very well for me as well, for a couple reasons. One, there's less of a range of prices that I think that we're going to hit for Amazon. And two, beyond that, there's one less day of risk that I have to put in waiting for expiration, because I'll buy the options tomorrow when the market opens, or not, I should say throughout the market day. And then I only have to wait out earnings and Friday for that to expire, because expiring within the price range that I set, that is exactly the place where we find that max profit with the Iron Condor. It is possible that if we get strong enough selling, that I do just pick a single direction on this one, such as call options would be the way that I would go. Should I pick a single direction on this one, or I could also do a call spread, a bull call spread on something like this to take advantage. That would limit my downside risk, but it would also cap my profits. There's always a balance between risk and reward that we get in the markets. So we'll see what kind of selling we get. If it gets further overdone, besides the over 17% that we've sold off from the high, if we do continue to sell, we might have to start looking for that death cross to come, especially if we start breaking down through that 200-day that we have up here. However, I said bullish on tech, still bullish on Amazon, especially after today. I think that we're starting to get really overdone on this, even if we haven't showed up as oversold when we look at the daily chart for Amazon. So let me wrap up this video here. The markets themselves, man, it's a troubling time. And I'll tell you what, to have as strong a reaction as they did today, things are really out of whack. I think there's a lot of worry over the yields that we have and the U.S. government's ability to continue to service that debt. Should we go higher? If we break 5% solidly, things are going to get real messy real fast. So please pay attention to that bond yield and be on the lookout for those, because they can really continue to mess us up. Big tech, by the way, NVIDIA, still bullish on NVIDIA, but oh my goodness, the massive head and shoulders pattern that we have on that one. I'm going to have to make a video on it for the morning, but that is absolutely something that we want to watch, because that could set up some significant buying opportunities for us moving forward for NVIDIA. Maybe we finally close that gap that we saw from their huge run up, where they completely gapped up with like a 25% jump from their earnings to the next market day. So that's another video. As a matter of fact, I'll make that my next video, is talking about NVIDIA and seeing from a technical analysis standpoint where they could go. So big tech, absolutely keep an eye on it. Amazon earnings, make sure that you're watching them. Meta, I think it's possible that we get a run up tomorrow. Maybe even the markets bounce a little bit tomorrow based off of what we got for Amazon earnings, because they had a 20% beat in earnings, by the way, which is absolutely awesome. After 20% surprise, that is almost unheard of from the more mature companies that are out there. Like I said, watch out for those Amazon earnings as well. I'm going to continue to do this coverage, and also I'll toss in another SoFi video as a precursor to their earnings, which take place on Monday, October 30th. Thank you guys for watching this video. Don't forget about joining me down in the Patreon to see my buys and sells. Join my community. Absolutely wonderful and awesome people over there. We would love to have you come and join us. And your free stocks from Moomoo, get access to a wonderful trading platform that is really good for helping you out through this process, including the learning materials that they have for it and the free stocks to boot. Thank you guys. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.